While U.S. markets have been standout performers in the past couple of years, guest today says there's some macro headwinds, plenty of opportunities overseas. We talk so much about America. Now we're going to look overseas for our investors. Joining us now to discuss, Michael Brown, VP, Director, and Co-Lead of Fundamental Equity Research at TD Asset Management. Michael, great to have you back on the program.
Thank you for having me.
These are interesting times. I don't know if that's a blessing or a curse, as the old saying goes, but we have so much to talk about. The Trump tariff threat, international equities. What a fascinating way to look at it through those lenses. What do we see?
Well, I mean, right now, I would say that there's not many countries out there that aren't feeling the threat of tariffs. Like you look at China, where they keep changing the amounts. I think the latest was 10%. There's also threats on Europe. There's threats on Mexico. And then, so basically, it's a broader overhang. So.
Broader overhang, and we don't simply know either the end game here.
Yeah.
Will there be a tariff? Is this a negotiation tactic? It's a lot for sort of governments and businesses to wrap their heads around.
Oh, especially trying to do long-term planning. If you think about some of the like auto companies in China, or for instance, like.
Let's break down some of the tariff things too, because I think people are trying to understand as to why Canada would be included in that mix. Mexico, don't we have like a continental free trade agreement? China, obviously, there's been long-standing tensions, whether it was the Biden administration or the return of Trump. As you start thinking about tariffs globally, is there a way we can start segmenting different countries, different regions from an investing perspective?
I think, like, by far, I believe the oddest part is for Canada with the 25 threat, which does not seem logical. But with China, it's a threat against largely subsidized industries, particularly the current focus being on electric vehicles, some of it being also in the semiconductor industry where there is some national security issues, some constraints on that, as well as cheap goods coming into the States. So there is some logic to that. He has accused multiple countries of being currency manipulators. I mean, it's got to be a factor in the expected rate increase in Japan this week. So be the second rate increase in a very long time. So.
Right. When you mention currency, obviously the U.S. dollar the U.S. economy has been strong, resilient. The U.S. dollar has been strong. When we think about investing internationally, what do we need to know about the U.S. buck?
I mean, with the U.S. dollar, like the key, like essentially you're looking at countries that are restricted on what they can do with monetary policy because of imported inflation. Like, for instance, if you look at food being imported into Japan, typically priced in US dollars or other commodities, that flows through into the economy. It almost forces their hand to raise rates to control inflation, whereas they would rather be more stimulative into the economy. So.
And you mentioned Japan. The last time we were on the show, we talked about Japan. Obviously, it was in the headlines a lot through the summer of last year. People still say that things look interesting there. What is the situation in Japan right now?
I think, well, in Japan, this would be essentially the final land of Shinzo Abe's third arrow from 2012, where you're seeing an actual renewed focus on profitability, obviously balanced with the Japanese culture of society as well, but looking at lowering cash on the balance sheet, buying back shares, all these measures that we take for granted in North America or most of the Western markets now really are in flux and popular in Japan. And a focus on, they have an index where participants have to have an ROE or trade at a price to book above a certain level, which is a function of ROE. And so that renewed focus on profitability is very real. So it's quite positive, and it's across sectors.
Since we talked about Japan last summer, I've noticed one of the ETFs that tracks Japan, sort of choppy trade. I mean, it hasn't pulled back. It pulls back, it goes higher, it pulls back. Yeah. Are we sort of waiting this to still get through sort of the chop of all this?
I think a lot of it would be the volatility in the yen. There's also, they had significant wage increases in Japan, but there really is the volatility of the yen and the impact on exporters, this changing rate trajectory. So, I mean, but there are some positive areas. You look at Japanese banks. It used to be it was a career ender to invest in Japanese banks, but for the last 2 years, beneficent. I mean, if you go from negative interest rates to positive interest rates, even if you only go to 0.25, that's still very significant profit growth. So that's been an opportunity over the last couple of years in terms of Japanese banks. I mean, the downside risk, of course, is they're still Japanese banks, so where they do have a lot of overhead, excess staff. They're not going to lay people off for efficiency gains. So if you think of Canadian banks running with 40% efficiency, they'll be typically running close to 70.
Okay.
So
interesting stuff there in Japan. Australia, you say you're interested in Australia. We don't talk about a lot of that country or that market here on the show. Walk me through that.
Okay, so you look at the Australian market, it is, I mean, similar to Canada, it would be a large financial, essentially oligopoly of banks, well-run, high ROEs, solid dividends, solid GDP plus growth. And on the other side, there's the metals and mining, which largely flow through to China, so property, not the best place at the moment. But on top of that, there's other unique businesses, like one that we've been looking at would be Goodman Group, which is an Australian REIT, but they're specializing in data center rollout throughout Asia. So when you hear about the essentially areas of easy access to power, they're typically the company building those assets there throughout Malaysia, throughout Australia, parts of Japan, so data center growth is not just in North America, and that would be an area that's a focus there. On top of that, there's some actual e-commerce companies, like there's an auto trader or real estate similar to Zillow. All of these are fantastic free cash flow companies, so it's quite exciting. And on top of that, you've got relative currency stability and potential for rate cuts, consumer sentiments improving. Things look pretty positive.
What would be the risk in the Australian market? Maybe central bank policy doesn't play out the way we think?
Central bank policy is always a risk, and obviously tariffs play into that as well. Then the other would be, I mean, they do export a lot of iron ore, a lot of coal, so some trade restrictions on that. And then a lot of that iron ore would be going to China, so slowdown in the Chinese economy would be negative for Australia from that effect.
All right, we've talked Japan, we've talked Australia. Europe, though, you're saying it's a bit of a tougher environment there.
Yeah, Europe is notably lagging from a GDP perspective, from a growth perspective. The ECB has telegraphed rate cuts. I mean, fortunately, we have a German election coming up in February, so that should provide some stability. It appears we're moving gradually towards political stability in France. With that, maybe there can be a unified response. That would be positive. I mean, also looking at Germany, where you would look at like the auto industry, a lot of their pains stem from essentially the EV proliferation of local producers in China. Whereas, so for example, BMW, 64% of their growth was largely in China. That is now, a lot of that's going to EVs in China, which is hurting their margins, hurting their production. So, but beyond that, beyond the auto space, there's some very good German companies as well, like Munich Re, a leader in insurance, or SAP, which is a global leader in enterprise resource planning software. And the dominant just happens to be domiciled in Europe. So there are opportunities away from the auto sector and the GDP macro sensitivity.